Hello, everyone. This is an economic and market valuation update. Today is Wednesday, August 10th, 2022, and I'm your host, Mayur Thaker. I am an analyst and senior relationship manager here at Zacks Professional Services. And let's get started. There's a number of important updates that I wanted to have everybody up to speed on in terms of what things I'm watching personally with regards to where the macroeconomy is headed. With regards to inflation, as well as the debate over whether or not we are entering or are in a economic recession. So let's get started. The key highlights that I've seen thus far is that right now the bond market is very bearish. Treasury yields have now inverted. We'll take a look at a couple of those charts in just a minute. And inflation expectations remain subdued. We've looked at, if you look at the price action of gold, as well as Treasury inflation protected securities tips, the copper to gold ratio, as well as the inflation expectations as published by the New York Fed, they're all in check and they're all sort of confirming each other that inflation expectations have actually come down quite a bit, despite the fact that CPI is still at 40 plus year highs. So this is the way that I like to interpret inflation expectations is that if inflation expectations are coming down, that can be bullish or bearish, depending on the reason for those expectations coming down. It's bullish if the declining inflation expectation is due to increasing production, right? So from the supply side, if supply is coming up above demand, then we can see, prices come down, and that would be good because that would be supply side driven, controlling of the inflation that we're seeing. But it's bearish if it's coming down due to demand destruction. And that's what we typically see in recessions, is that inflation expectations get hit very hard during recessions, and that's because demand is evaporating, because jobs are scarce, because incomes fall, and other things like that. Disposable income falls, where consumer behavior shifts back to being defensive rather than indulging in nice to haves, and refocuses their available income on necessities. So we want to make sure that inflation expectations are coming down for the right reasons. So we'll take a look at what that looks like in just a minute here as well. Meanwhile, on the supply side, production gauges remain expansionary, but the rate of change is slowed. So we've seen the Chicago PMI at 52. We've seen ISM manufacturing at 53. Both, remember, as long as it's above 50, that means that those indicators are still expanding. But the numbers have come down from the 60 plus readings that we saw just earlier in the year, and now are just barely above 50. So we see that the rate of change has slowed quite a bit. So if that drops below 50, these are coincident indicators of recession. So if they do drop below 50 and stay below that for at least a couple of months, that's a pretty strong indication that we're in recession. But that has not happened just yet. Other indicators, though, are very, very bullish. For example, the factory orders and new orders for durable goods, they actually remain very strong at the top end of the range that we've been in for the past decade during the very strong bull market that we've been in. Factory orders are up 9.7% year over year. That was just reported last week. And new orders for durable goods, that's up 5.8% year over year. So that's very, very strong readings that we're seeing on the demand side. With regards to, production and, demand as well. And the backlog, remember, this is an indicator that I've been talking about quite often in these webinars that we hold here. We've been tracking the correlation between backlog and the CPI. The CPI, as we all know, has been hitting 40, plus year highs. And we can actually see that simultaneously the ISM backlog index has also hit, 40-year highs. So that makes sense. As the backlog rises, inflation rises because demand is outpacing production. And as backlog falls, so should the CPI. So let's take a look at what that looks like here. And so this is the chart that we looked at. This is the yield spread that I was talking about. This is very, very clearly forecasting recession. We saw that, this 10-year minus 2-year spread is very, very, has a very strong track record of recession. We saw that happen each of the last 5 recessions. You can see that it inverted right before the great financial crisis. It inverted right before the dot-com bubble burst. It inverted right before the recession of 1991. That happened to be during the Gulf War time. It inverted right before the 1980 recession. That was during that high inflationary period that we got. It also inverted right before the 1973 recession. So this is a very, very good indicator of recession. Right now it's inverted as well. So the bond market is very clearly forecasting a recession. That is the base case. And this indicator has never been wrong, at least not in the last 40 years or so. So very, very strongly do we see a recession forecast from the bond market. Confirming that recession call is gold, as well as tips. We see that gold, despite the fact that the CPI is hitting 40+ year highs, look at gold here. It's basically flat to negative over the past 2 years. Yes, it is up over a 5-year period. This is a year-over-year percentage change for gold. But you can see that there's a stark contrast to what we saw in the late 1970s and even in the 1973 period when we had very high inflation. Those are times that were marked with, soaring gold prices. But right now, we're not seeing that at all. In fact, we're seeing a wide divergence here. So this is telling me that the inflation that we're seeing here is mostly supply side driven. It's not as much monetary as it is supply side, as we see from gold prices here. And we can see that from tips as well. Remember, tips are, Treasury inflation protected securities. Tips do well when inflation expectations are rising, as we saw, starting in 2019. We had a huge hit to inflation expectations during the COVID crash, but we saw that number recover quite rapidly into 2020. And, it really topped out in late 2021. And since then, inflation expectations have really cratered and have not recovered since then. So despite the fact, again, that the CPI is hitting, 40+ year highs, we're not seeing that translated over to the bond market as captured by TIP, the ETF that tracks the Treasury inflation protected securities market. So, two very strong markets are both kind of confirming each other. Gold as well as tips, they're just not performing very well, despite the CPI hitting, these extraordinary highs here. So that's telling us that the markets that track, the forward-looking expectations are not thinking that this high CPI is here to stay for a very long time. So again, the yield curve is indicating recession. That, again, could be driven by demand destruction. Gold is not really projecting very strong inflation going forward, as well as tips. So all three are sort of confirming each other in the sense that, the CPI is most likely not going to stay as high as it is looking like right now. Over on to the supply side, we're seeing that the backlog is eased quite significantly here. We saw the high water mark, at a 71 reading for the ISM backlog index. Now we're at 51, so it's really dropped quite a bit since the last time we talked about this on the webinar. We're down to 51, and the CPI continues very strong at 9.1%. That is a little bit surprising to me, but I think that there is a little bit of a forward-looking indicator that the backlog has on the CPI. So the CPI is a lagging indicator. So I think that if this continues, or if it stays as low as it is right now at 51, I think that is a very strong tell as to where the CPI is headed, which is down. You can see that there has been a very strong correlation over time, between the backlog index and the CPI. And it makes intuitive sense, just logically speaking. The backlog, if it's very high, that means that demand is very, very strong relative to supply. And that would mean that prices must inevitably rise. And that's exactly what happened. But now that production has caught up with demand, we see the backlog drop quite a bit. And so I believe that the CPI is going to come down. All of these in conjunction with each other. So the combination of all of the above really suggests that inflation may be topping out and reversing course. Over on the demand side, we see demand remaining very strong. We saw, as I mentioned, factory orders are at 9.7% year over year. That actually remains at the top end of the range that it's always been at, throughout the entire post-Great Financial Crisis era. And every time in the past that we have seen during non-recessionary periods. So we see a 9.7% year-over-year growth in factory orders. And you can see that it's basically back at long-term trend. If you were to draw a trend line, you would see that the current value is basically at trend. So we've recovered all of the COVID drop and are continuing the trend growth that we've been in since basically the 1990s here. So this is very, very good to see here. So despite the fact that the yield curve is inverted, we're seeing demand at very robust levels. So for the recession to hit, we would have to see this number roll over here quite a bit. Other leading indicators remain very strong. Initial claims, for example, over on the employment side, the labor market side, that remains very subdued here. We'd have to see this pick up quite a bit again to be a forward-looking indicator of a recession. And initial claims are have a pretty good track record at predicting recessions in advance. So if this number picks up, year over year, then we will start to see that the yield curve inversion might be onto something. But as of right now, we just don't see enough of that. We don't see enough evidence to suggest that that is the case. And over here, we have new orders over on the manufacturing durable goods side. That remains very strong at 5.8%. This is also a slightly, ahead of the curve indicator of recession. So, we've seen that this number has come down quite a bit, but that's because it's off of a high watermark here, a very strong watermark of 50% essentially year over year. But that's because we had a depressed base in response to the COVID crash of 2020. So we're now finally getting normalized comps year over year. And that again is very, very strong at 5.8%. Again, just like the factory orders number, this remains basically at the top end of the range that we've been in during, bull markets. So the fundamental data is not yet confirming what the bond market is seeing over from the Treasury yield curve side. So again, but this is something that, maybe bond traders are seeing, is that we are seeing growth slowing. So we're seeing that the ISM manufacturing is at 52. Chicago PMI is at 52 as well. That's off of the high watermark here and is entering kind of the concerning level, which is when these numbers drop below 50 for an extended period of time. When that does happen, that is typically a coincident indicator of a recession. So we don't want that number to drop below 50, but we can see that that's where it is headed. But it has not yet confirmed below 50 just yet. Here's a very, very interesting number to watch. This is the Sahm Rule. And I highly encourage everybody to keep an eye on this one. This has been one of the most accurate coincident indicators of recession over the past 50 years. Currently, it's not forecasting recession. So just like all the other numbers that we're seeing here, fundamentally, we're not yet, predicting recession. But what this rule is basically looking at is we're looking at the unemployment rate. And what the rule looks at is the spread between the 3-month moving average of the unemployment rate and the 12-month low. So over the past 12 months, what was the low in unemployment, right? That's one number. And then we look at the current 3-month average unemployment rate. If the spread between those two ever crosses above 0.5%, So that's, 0.5%. That would be right in the middle here between that 0 and 1 number. If the spread ever crosses above 0.5, it has correctly called a recession over the past 50 years with not a single false positive. This is very, very important to see here. So it's had an extraordinary track record at predicting recessions, and currently it's not predicting one. But if it ever does cross over, and I went back and looked at how well it did in 2008, and it did very well. In fact, it crossed over 0.5 in April of 2008. So that's very important because remember the event that broke the market eventually was when Lehman crashed and was declared insolvent, and the Fed was not able to rescue them. That happened in October of 2008. Whereas the Sahm Rule basically gave you a warning that we're in recession in April of that year. So you had a 6-month advance notice that we were entering recession or that we were already in recession. And remember, the NBER already declared that we were in recession in January of that year. That was in hindsight, but this is a real-time indicator. So if this number ever crosses above 0.5, history shows that it's, had a 100% track record over the past 50 years in terms of predicting a recession. So this is something to keep a very close eye on. But right now, it's not yet flashing recession. So remember, so far, the bond market is flashing a recession. But that's not yet confirmed by the fundamental data. We don't see that yet in ISM manufacturing. We don't see that yet in Chicago PMI. We don't see that yet in initial claims. We don't see that yet in durable goods orders. We don't see that yet in factory orders. And, we don't see that yet in the backlog index, right? So, all of these fundamental indicators are not yet confirming recession, but the bond market is. So let's see which one is right. Remember, I don't like to doubt the bond market. That's a very bold call to make. You never want to, across, the, bond traders out there. They're a very, very smart group of people. And that yield curve spread has been very, very accurate at catching recessions in advance. But, as a prudent investor, I would not like to take just one indicator and run with that. I would like to see a couple more confirm that before, getting truly defensive with my portfolio positioning. By the way, and this is an important next point that I'd like to make, which is that recession calls that cite the collapsing housing market are somewhat flawed because home prices have soared well beyond long-term trend. So again, this is something that you're going to be hearing in financial media all the time. People citing, this indicator and that indicator, with regards to housing, is flashing recession. But I take that with a grain of salt because if you look at this chart right here, the median home price in the US is way above trend. Far, far above trend. So, if you were to see this, drop or roll over here, by traditional metrics that follow trends, they're going to start saying, well, holy cow, this is looking like recession because we've never seen housing prices corrected that sharply without there being a recession. But let's keep in mind that, we've seen an extraordinary explosion above trend to an extent that we've never seen in, more than 50 years. So think of it this way, if a stock doubles in 6 months and then suddenly has a 30% correction, technically that stock is in a bear market. Because if the traditional definition of bear market is anything above a 20% correction. But, that sort of ignores what just happened right before that, right? So if the stock doubled very quickly and then dropped by 30%, suddenly everybody thinks that company's in a bear market and that, it's, flashing a warning sign for what's to come. But that's, taking it out of context, right? And that's the better way to look at it is, well, where are we relative to long-term trend growth? So I could see, housing prices come down quite sharply without there necessarily being a recession. And that could be simply because, housing prices are coming back to trend. So mean reversion does not necessarily mean recession, even though it would require quite a draconian drop in housing prices. So that's an important point to track. So anyone that cites home prices as their evidence that we're entering recession, I think is a little bit deceiving in a way. So I would like to see some of these broader economic indicators roll over. I would like to see the Sahm Rule confirmed. I would like to see Chicago PMI confirm it. I would like to see initial claims confirm it, or durable goods orders confirm it, or factory orders to confirm it. I need to see a couple more of these numbers confirm recession before, kind of agreeing that the market is in recession and it's time to get defensive. And remember, these are forward-looking indicators. A lot of this stuff is forward-looking or coincident. It's not a bad thing to wait for confirmation before going defensive or going into sort of a defensive mindset with regards to the way that you're investing. And the most important question, though, for investors is not about whether we get a recession or not, right? We always talk about whether we're in recession or not. We see debate, that being debated endlessly in the financial media. But that's not the most important question. The most important question is, what expectations are being priced in already versus what are we actually going to get? Because remember, the market's already had a 20% drawdown. And the NASDAQ has had an even bigger drawdown of 30%. So that means that certain expectations of recession are priced in. So what matters more is not whether we get a recession, but what we're actually going to get in terms of an earnings slowdown versus what we're, pricing in already. So we can see here that the S&P forward PE multiple is basically near the 25-year median. Right now we trade at just about 18 times forward earnings. The 25-year median is about 16 and a half times earnings. So we're almost back to sort of the median multiple on forward earnings here. So we've already seen, a considerable drop in forward earnings expectations being priced in by the investor community as it stands already. We can see that, price to free cash flow is basically close to the post-Great Financial Crisis median. Over this entire, 12-year time period. Right now, the market trades at 24 times free cash flow. The median value is about 22 times. Not that it can't go below the median. I'm just saying that, we've already seen a considerable pricing in of, expectations being cut, as we see by this multiple compression here, both on PE and price to free cash flow. So again, the question is not whether we get a recession, but what the expectations are relative to what we actually get. And analysts, and keep in mind, we're more than 3/4 of the way in. In fact, the vast majority of S&P 500 companies have now reported Q2. Half of 2022 is in the books. And analysts have not yet slashed earnings forecasts meaningfully. This is important to see. This is, I think, meaningful here because we've gotten half of the year in. We've gotten, many quarters of high inflation. And yet, we have not seen analysts slash their earnings expectations for this year all that much. And the expectations for next year are slashed by a little bit, but year over year, it's really not that much at all. In fact, we're up about 1% from a year ago. So yeah, we're down from the high water mark, but year over year, we're actually up by 0.8%. So is the trend down? Sure. From the highs, yes, it's down, but it's really stabilized, over the past couple of weeks, which is when the vast majority of S&P companies have reported. So that to me is significant, that we haven't had significant cuts to earnings expectations for this year or next year. Margins remain stable. Look at free cash flow margins through the second quarter of 2022. Despite very high inflation, we're seeing margins very, very stable. In fact, we're basically at the median number that we've been at for the past 12 years. You can see free cash flow margins at 16.4%. And in fact, we're much leaner than where we were versus the 2000 market top. S&P companies were at roughly 11% at the very high end, right before the dot-com bubble bursting. We were under 10% right before the great financial crisis. And right now we're at 16.4%. So we're basically, companies have never been leaner. We've gotten to a very high water mark here of, about 20%, 21%. But that's going to fluctuate, right? Because free cash flow is a function of operating cash flow as well as CapEx. So that's going to fluctuate a little bit, but we're basically at the median number here in the entire bull market of the 2010s here. So again, this is indicating that companies are very, very resilient, despite the macro headwinds that we've seen, and are translating every dollar of revenue to about 16 cents of free cash flow, which is spectacular. And it tells you that we're very much more efficient today than we ever have been in the past 30 years, and inflation is being handled quite well by S&P 500 companies. Let's look at balance sheets. Look at the corporate balance sheet here. Total debt to capital. We're basically at the 30-year low in terms of leverage. So corporate balance sheets are very, very strong. Total debt as a percentage of total capital is very low at 44, almost 45%. That's very low, versus the numbers that we've seen, right before the great financial crisis. Buybacks are very strong as well. Companies have bought back a significant number of shares, and shares outstanding for the S&P are basically a fraction of where they were, just 10 years ago. All of this in combination, the reason why I'm walking through all this is because it's telling us that leverage risk is very low for the S&P. Profitability is very high, and because shares have been bought back by a significant amount over the past 10 years, the extent to which we retest levels that we saw 10 years ago is very, very low. The probability that we go back to those levels that we saw in 2012, 2013 is very, very low. So that puts a cap on the extent of the drawdown that we ever would see if we saw a recession get a little bit stronger than we are currently sort of pricing in. So in my view, putting all this together, I think that given the multiple compression that we've already seen in the S&P 500 as well as the NASDAQ, I think a 10% earnings drop is already priced in. We saw a 20% decline in the S&P 500 from top to bottom, a 30% decline in the NASDAQ from top to bottom, and quite a significant compression in the forward multiple, both on PE and price to free cash flow. So I think overall, the base case is that a 10% drop in earnings is priced in. And right now, analysts are not even forecasting a drop at all. In fact, analysts are projecting, growth year over year. If we go back to this chart, the average S&P 500 company is projected to be at $5.89. This is the bottom-up reconstructed average, by the way, not the top-down number, which is what you might be used to seeing in financial media. But that's at $5.89. Analysts are expecting $6.36 next year. So that's, roughly, what is that? Roughly, 8% growth year over year. That's nowhere close to a minus 10% drop. But that's, I think, what we're already pricing in. So again, the bond market, as per the Treasury yield curve, is flashing recession. So if that's associated with a 10% earnings cut, I think that's almost priced in. So we would need to see a profit drop of more than 10% for us to get, much more bearish than we already are. So that's kind of the base case. If you think that a profit drop greater than 10% is in the cards for sometime over the next 4 quarters, then I think there is further downside. But if we don't get a profit drop more than 10%, that would be bullish from current levels. And this is just my opinion, based on all the data that I'm seeing here, that we've discussed here. And so my opinion is also that, given yield curve inversion and the CPI hopefully easing, given the other indicators that we've seen that leads the CPI, I think there's a pretty strong chance that the Fed might start cutting interest rates at some point next year. We might be a year or maybe, 18 months out from that, but I think it's a pretty strong likelihood here. A lot of people say that, well, we've got 9% inflation and only 2.5% Fed funds rate. That means that we're, going to double, the interest rate here, and we're still far off. I think that sort of commentary is not, accurate because, again, we see a number of indicators that lead the CPI that are communicating something very, very drastically different from what the CPI is saying. And remember, the CPI is a lagging indicator fundamentally. So because of the yield curve inversion, because tips are down, because gold is subdued, and because backlog is down, I think all of these numbers are basically pointing to the CPI coming down. So that if that's the case, then I see a very strong chance that the Fed starts cutting interest rates next year. Again, if the CPI as well as the PCE, which is the number that they follow, I think both of these numbers should start to come down over the next, 6 months to 12 months here. It'll still be high, but the rate of change should be coming down. And we're going to start to see that hopefully this week with the CPI number coming out. So overall, I think the focus should always be to focus on equities that have steady growth, high ROIC, with a sustainable moat, and in R&D or in brand loyalty, especially for companies whose multiples have been cut. So the common underlying theme here is focus on strong ROIC, right? Focus on businesses that have delivered, results consistently in recessions as well as in boom times. So again, this is kind of a direct lead-in into the Zacks earnings certain portfolio. That's kind of how we should be investing all the time. But especially if you think that we are falling into recession and if we are going to see a profit drop of greater than 10%, then now would be the time to start getting defensive. And the Zacks earnings certain portfolio is, one of the best defensive portfolios that I've personally come across. And I know I'm talking my own book here, our own book, but, it's the reason why we, have very, very strong confidence in that portfolio. So again, if you'd like to learn more about that portfolio, please, send us an email or see, our various other, videos that we've made on our YouTube channel talking about the earnings certain, portfolio, and why that is such a great, portfolio, especially during, bear markets, and yet still performs well over a complete market cycle. So hopefully you found all of this helpful. If you do have any feedback or if you have any other comments or questions, please do reach out to us. I'd love to hear from you. If you are a ZRS client, you can reach out to us at zrs@zacks.com. And if you are a Advisor Tools client, please do reach out to us at zat@zacks.com. And thanks everyone, and hope to see you guys soon on the next one. Take care.